Hi, in this video, we'll take a look at the final allocation of your different asset classes within a portfolio that combines risk-free assets and risky assets. So we haven't really talked about what is the risky asset part in our portfolio. So recall our previous videos where we had the two-stock situation. We have this U-shaped curve that represents the relationship between the return and the risks for the risky assets. So we only need to adjust the different weights for the different stocks to get to different points on this curve. And remember, this section of the curve will be strictly dominated because for the same risk, we'll have higher returns if we choose differently. Right? So we can add on different stocks. We can have more than 2 stocks, 3 stocks, 4 stocks, numerous stocks. We'll still have the same relationship here. Okay, and the maximum number of the stocks, or the maximum a number of different stocks we can have, is the whole market, right? So we'll deal with that later, but here we're just going to determine what is the final allocation here, provided we have some sort of available stocks or available risky assets here, right? So anything or any risky portfolio within this curve is going to be available, or that is lying on this curve will also be available. It's just a matter of choice. Anything that is outside of this curve, let's say somewhere here, they will never be available, right? So let's combine the risk-free assets with our choice of risky assets here. Okay, so still we start with the risk-free rate here. That is, we will invest all our available funding into the risk-free assets, so we'll get the risk-free rate with 0 risk here. Okay, and then we can pick any available risky assets here. So let's start with, for example, here, let's call it sigma k and rk here, right? So from what we have learned is that the combination is a linear relationship, right? So the portfolios on this straight line will be available for us to invest. But are they the most efficient portfolios here? And you can see, starting from this point here, anything that is higher than our chosen portfolio would be strictly dominating, right? So anything higher would be dominating our choice. So this bit on the curve or the risky assets will give us a higher efficiency because for the same risk, they will give us the higher return. So there's no need to purchase or to invest any of these portfolios here because we have better choices here, right? So for any investor, as long as they're rational and they care about the return and the risks, so they will never choose to purchase or to invest the portfolios here. They would prefer the risky assets here, and they will only invest in risky assets for this section of the curve, right? So let's take a look at yet another portfolio. So let's say here, okay? So theoretically, we can still draw a straight line here, but is this thing here or any of these portfolios available or feasible? No, because we'll still need to pick our risky assets from what has been given to us. Okay, so suppose this is the whole market. This is not attainable, feasible, because it's outside of the market. So there's no point trying to get to this this return and this risk here, right? So what is the best outcome here that is still feasible but provides us with the most efficient portfolio? So naturally, we would like to have a higher Sharpe ratio or the gradient of this straight line as possible, but also feasible. So the natural conclusion would be when we have a straight line that is just tangent to the risky assets here. Okay, that is just tangent, which means that's the highest gradient or the highest slope or the highest Sharpe ratio ever available given the set of the risky assets and given the risk-free rate. So this line here would be our final efficient frontier, right? So the intuition behind this efficient frontier is that every investor in this market should hold the same risky asset portfolio, which is at this point. Okay, so let's call it a sigma E for being efficient here. Okay, so every single investor should invest here as their or invest in this portfolio for the risky assets as their efficient outcome. Okay, so let's write it here. Let's call it sigma E here and RE here. Okay, and depending on their risk tolerance or risk profile or utility curve, they can choose to save or choose to borrow. Right? So again, this is on the assumption that we can save and borrow at the same rates, which is the risk-free rate in this case, right? So depending on their risk profile or their preferences or their utility curve, indifference curve, we could have somewhere here. Okay, so any investor could invest here, and we could have somewhere here as well. Okay, somewhere here as well. So this investor would be saving, and this investor here with the purple indifference curve would be borrowing. Okay, but they will always hold the same risky portfolio. It's just the weight on this portfolio would be different. And how do we change the weight on the risky assets? We change the weight on the risk-free assets, right? By borrowing or by saving. Okay, so in conclusion, this line, this straight line here, that just cuts the available risky assets portfolio, or is going to be tangent to this curve, will be our optimal choice. And this portfolio is sometimes also called the tangent portfolio, okay, because of the tangency here. So it's called the tangent portfolio for your risky assets, right? And if you want to hold, more risks, or if you would like to bear more risk and consequently get a higher return, you could just borrow more, right? And if you dislike risks and you're risk averse, so you can save a bit more to decrease your risk and then consequently decrease your return a little bit. So it's all the investor's own preferences and their own choices, but they will always lie on this line. Okay, and remember, the assumption is that we can borrow and save at the same rate. Okay, so this is the final efficient frontier if we combine the risky assets and the risk-free asset. You can compare this with the situation where we only had risky assets. So if we only had the risky assets, then this thing will no longer be available. We'll only be having this curve here. So the risk with only risky assets, the efficient frontier is anything that is not dominated, right? So this bit will never be efficient because they're strictly dominated, and this section will be strictly dominating. So anything that's on this curve will be your efficient frontier if you don't have any of those risk-free assets. Okay, so in the next video we will discuss what if that assumption where we can borrow and lend at the same rate is violated. How would this change our final allocation of our assets, or how would our efficient frontier change if we cannot borrow and lend at the same rate? I'll see you there.